Half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm Yvonne Man with Annabelle Jewelers.
Our top stories: concerns over China's economy grow as local governments slash spending and youth unemployment climbs to its highest level this year.
Geopolitical tensions also weighing on market sentiment, with the U.S. set to prepare a ban on Chinese cars software and hardware.
China, meanwhile, taking center stage at a meeting of Quad leaders. President Biden testing or telling allies Beijing is testing them all.
Plus, a leftist political outsider wins Sri Lanka's presidency, promising to renegotiate terms of an IMF bailout and scrutinize deals with China. Happy Monday. Hope you had a good weekend. Here you take a look at how risk assets are doing. It looks like we pressed a bit of a pause button here today. Keep in mind, Japan markets are shut on autumn equinox days, but we are still talking about Asian stocks that are staying around those 2-month highs. We also saw the best week in a month post-Fed meeting. So it looks like right now we're seeing a bit more of a mixed picture. U.S. futures are still punching a little bit higher. U.S. dollar is pretty much flat here this morning, and we're watching that dollar-yen trade. It's still leaning on the weaker side for the yen at 144 levels after that BOJ meeting that we saw on Friday as well, with Governor Ueda in no rush, he says, to tighten policy as well. Given that treasury markets are shut in Japan, we're seeing them slightly in the red here this morning, but definitely we're talking about those yield curve steepeners that seem to be finally working, right? The gap between the 2s and 10s have been the steepest since June of 2022. And what Governor Waller from the Fed mentioned on Friday in that interview, one of the first that we've heard from the Fed after that jumbo size cut, was maybe that another 50 basis points could come to pass if they continue to see this job market weaken as well. So that's something to keep in mind. We did see the market move on that. Yields were initially higher. We reversed a little bit on that on Friday. And right now, keep in mind, though, we have a lot of bond auctions in the front end to talk about this week as well. $184 billion worth of Treasury supply. So certainly one to watch this week as well. You take a look at how gold markets are doing. We did reach that record high last week. We're pairing off that a little bit. Brent still elevated around $74 here right now, but iron ore, you're seeing that down some 1%. So there was some interesting data that came out of the weekend, which we didn't really quite expect from China, right? The youth unemployment rate, the budget spending numbers that seem to tell the same story of economic gloom. That's what you're seeing, perhaps, that China commodity futures are sort of falling on a bed here this morning. Look at iron ore. Dalian futures are down some 3%. Steel's down about 2.5% this morning as well. The approach to the open is this, though. We're coming off on a pretty good week when it comes to mainland markets, especially when it comes to Hong Kong. HSCEI, I believe we were up about 6 sessions. That's one of the longest winning streaks we've seen since April as well. The best weekly performance we've seen since about 5 months ago. I think it was a 5% gain. Property, very much the beneficiary of those Fed cuts in Hong Kong, if you talk about the ones developers there. Also, when it comes to all these scoops that we have on maybe more stimulus coming to the property sector in the mainland as well. Futures, though, are slightly in the green here this morning. We're watching that dollar China trade 704.52 bell.
Yeah, it really looks like, though, that more positive sentiment we'd seen around China last week post the Golden Week holiday period is sort of set to give up when you get into that session today, because, I mean, we can get through all of the economic data, but certainly not good numbers coming through over the weekend with budget spending, youth unemployment. So that's something we're going to be tracking very closely. Property stocks, of course, that continued focus we have on the property sector, possibly more relief measures coming through, but economists are saying really much more is needed if China has any sort of chance of meeting that 5% property target, or growth target rather. What else we're tracking in the session today is around property developers in general. We've got Sino-Ocean Group holding a liquidation hearing Monday morning at the Hong Kong High Court. We're already hearing that they're going to be taking on a parallel debt restructuring process. Macau visitor arrivals data, those numbers due later today. We did actually see that the hotels were fully booked in that Golden Week period as well, so something we're going to be tracking, local media reporting that. And then also we still have Steve Engel on the ground for us in Shanghai for the International Business Leaders Advisory Council that was kicked off on Sunday, but lots of different business heads there as well, so we can get more of their reaction. What's happening on the ground? What are they hearing against that backdrop of going back to the data we had? Yeah, talking to Rio Tinto and the like here certainly is a best gauge of where that sentiment is here right now. We'll bring you that interview in just a bit here, but let's take a look at what we were talking about, right? The data that we got
Broad fiscal spending down some 2.9%. So that deepened and got worse than what we saw in the previous months as well. That just goes to show how strained these governments are, local governments are in some ways as well. But the youth unemployment rate, 18.8%. It's the highest we've seen this year, and it's the highest we've seen since they changed the metrics as well.
That recalibration, I know you're taking out those students and saying that they really shouldn't fall into it. So it really just tells you how dire that picture is right now, given you've got those levels. It's particularly interesting when you put it against that backdrop. We just had them raising the retirement age as well, and that was sort of one of the key concerns, that if you raise the retirement age, you're going to have more labour supply in the market at the same time when the youth still don't seem to be able to get jobs.
Yeah, that is an alarming sort of trajectory here, but we'll continue to watch this story and whether it does weigh on markets here today. As we talked about, Chinese markets have been a little bit more upbeat of late. Let's bring in Paul Dobson, our Bloomberg executive editor for Asia markets. Paul, set the scene for us this week. Obviously, we got through with the Fed. Seems like Asia really benefited and enjoyed that party. What's in store this week?
Good morning. It's a lot to watch out for this week, I think, on the macro side, and thinking about the US. Now, we got through the Fed and we got through the options expiries for US stocks at the end of last week. We're starting on a bit more of a stable footing. The market seemed to be pretty positive overall in its reception of the interest rate cut by the Fed, roaring back as it did on Thursday. And this week we will get some more inflation data from the US, which may well validate that Fed decision to do the 50 basis point cut. So now the market's going to start to ask itself how much more cutting is the Fed going to be doing through the rest of this year. We heard some comments from Waller from the Fed at the end of the day on Friday, talking about more cuts and possibility of another 50 basis point cut in November, depending which way the data between now and then falls. So there will still be a good focus on the attention, not just on inflation, but of course on jobs data as well between now and then. I think for the Asia picture, as you were saying, that Chinese data that we had over the weekend, another piece of a gloomy looking puzzle, and yet the markets have received some elements of support over recent days. Now, on Friday at the close, we might have expected that there could have been a triple R cut. That's usually a good window or a moment when they tend to do that. There wasn't anything, so one opportunity for some stimulus to come through early in the market's view was missed there, and so perhaps that will set us back a little bit as we start trading again today.
All right, that was our Bloomberg executive editor for Asia markets, Paul Dobson there. And of course, not just focusing on the Fed's preferred inflation gauge. This week, we've got a slew of numbers that are coming out in Asia as well. So later Monday in Singapore, we'll have the inflation figures. We've also got inflation figures dropping in other parts of the world. Tokyo CPI, that's a leading indicator coming through in on Friday against, as we said, the US numbers as well on Friday. What else we're tracking, though? We've got central bank decisions on tap, the RBA that's coming up on Tuesday, and also, of course, looking ahead to MLF rate decision in China. We've also got industrial profits from China coming out, and the all-important Japanese LDP election taking place at the end of the week, Yvonne.
Yeah, I mean, the US PCE, as Paul mentioned, is probably going to be the biggest thing to watch as well as the next sort of hurdle, right, of where people are looking at what the Fed's going to do. We also have central bank decisions out of SMB, out of Sweden, which are set to maybe follow the Fed. We'll see how big, if it's going to be 50 or 25. But the RBA seems to be in a bit more of a holding pattern here. We'll see if those CPI numbers change anything in terms of the thinking as well. Let's get to a little bit more about this Bloomberg scoop. Learning that the U.S. Commerce Department is planning to reveal proposed rules that would ban Chinese and Russian-made hardware and software for connected vehicles as soon as today. For more, let's get to our China correspondent, Min Lo. She joins us now. And tell us a bit more of the intention and the impact of this proposal.
Yeah, the intention is to address the security concerns around this new generation of smart cars that would have devices connecting the vehicles to the internet or to cloud services that would then make them potential target for hackers. So the proposal would ban Chinese and Russian software as well as some hardware. And the intention is to prevent hackers from being able to intercept these vehicle communication systems using software that are developed by China and to track these cars or to send data collected on U.S. drivers back to China. Now, the goal is to get this proposal enacted by January before Biden steps down, obviously. And of course, there is a national security element to this, but it's undeniable there's also some sort of protectionist element to this, because the side effect is that it would then prevent Chinese car makers from then selling cars that make use of these Chinese software in the U.S. And it might also close that loophole of allowing some car makers that have plants in Mexico, for instance, to export cars through Mexico to the U.S. because they contain these software as well.
And there's also that Quad Leader Summit that we've been watching in the US as well. And President Biden caught on a hot mic at this. I mean, we just mentioned there, he said that China was testing the US and allies, but what else did we hear from him?
Yeah, so he took quite a different tone when he thought he was in private with the foreign leaders versus when he was in public at the public opening remarks. This was a meeting between the Quad leaders, which is a loose alliance between Japan, Australia, and India and the US. The leaders were meeting in Delaware in President Biden's hometown. And at the opening remarks, you know, there was no explicit mention of China. Prime Minister Modi explicitly said that they were not against anybody. And you have Jake Sullivan, National Security Advisor, telling reporters earlier on Saturday that the Quad is more than just about one country. But then when reporters were escorted away, then you heard President Biden talking about China. Have a listen.
We believe Xi Jinping is looking to focus on domestic economic challenges and minimize the turbulence in China diplomatic relationships, and he's also looking to buy himself some diplomatic space, in my view, to aggressively pursue China's interest. China continues to behave aggressively, testing us all across the region.
And then President Biden then went on to raise the issue of China's aggression in the South China Sea, the East China Sea, the Taiwan Strait, and in South Asia, where China has border clashes with India. And he talked about how these are all issues that are relevant across all four Quad members. So we know that, yes, the Quad members, they have agreed to collaborate on all sorts of issues, including climate change, agricultural advancement, for instance, but still countering China is a key part of their agenda. All four countries agreeing to create a new observer program next year to enhance maritime security, a new training initiative to help the four nations better monitor their waters and to prevent unlawful behavior in the waters around them. So this is perhaps, you know, a sense that both sides are quite cognizant that what they say in public needs to be very sensitive, because any sort of deterrence could be interpreted as aggression by China.
All right, well, we'll get more, of course, on China ahead. That was our Bloomberg China correspondent, Min Min Lo, because we're going to be going back to Shanghai, where we're going to be hearing from the EU Chamber of Commerce in China President Jens Eskelund, joining us as global leaders meet in the financial city amid tensions over trade and technology. Also, of course, counting down to the open of trade in Shanghai, Shenzhen and Hong Kong. More ahead. This is The China Show.
Well, dozens of international CEOs have been meeting in Shanghai to share ideas and advice with the city's mayor. Let's get to our chief North Asia correspondent, Steve Ingles. He's in Shanghai for us this morning and joins us now with our next guest. Steve.
All right. Thanks a lot, Yvonne. One of those people that was at IBLAC, which is the International Business Leaders Advisory Council to the Shanghai mayor, was Jens Eskelund. He is the European Union Chamber of Commerce in China president. Thanks so much for joining us. So you told me that you thought it was a pretty good meeting, even though the headwinds between East and West are mounting. How so? How was it a good meeting?
I think that the focus, the theme this year was something that appealed to most participants. It was centered around innovation, AI, digitalization, and also the green transformation. And I think that most of the participants, if not all, feels that this is an important agenda to make progress on.
But these are the sensitive issues. These are where national security is coming into play between China and the United States. We just had that story that we just talked about just a few minutes ago. Biden administration reportedly looking at adding to the list of the technologies. This time, some of the telematics in the automobiles and connected cars could be on the list. Does this not cloud European companies' outlook on what is going to potentially be on the list next?
I think you're right. Maybe not so much on the green agenda, because I think most of us accept that China is playing an indispensable role in that transition. But on the digitalization and AI agenda, I think you're absolutely right. And I think it was acknowledged by most of the participants, issues like cross-border data transfers, but also talent attraction. I think there's a growing recognition in Shanghai that if you're not able to attract the best talent from around the world, and China is not doing fantastically at that at the moment, but if you don't create the conditions that allow people to easily come here and contribute, then you're will not be able to build these world-leading clusters. And I think that's a concern for the local government.
Well, what's your biggest takeaway from the 2024-2025 position paper that the Chamber just came out with a few days ago? A survey, I guess, of your 1,700 members here. Doing business in China, as I know, has always been challenging, but are the risks mounting?
Yeah, the risks are mounting, and I think it's important to state that European companies, they are not running for the exit. But what we are beginning to see now is that more and more companies, they're sitting on the fence when they are making decisions about additional capacity. Should I put it here in China, or should I put it somewhere else? The thing is that we have a lot of the perennial issues related to market access, red tape, and so on. But at the same time, we have beginning to see over the past 18 months growing capacity in the market, growing inventories, margin erosion. So, companies are beginning to see that maybe they can earn more, as much or more outside. So the question becomes, why China?
Well, yeah, why China? Are the rewards decreasing? Because these decades of investment, the home offices back in Europe probably want returns on these investments, but the returns are limited right now.
Yes.
Profit margins are shrinking. Some companies are losing money here right now. So what's the answer to that question? How long do you stick with it at a time when the Chinese economy is down, consumption is down?
And I think that's the risk right now, that companies, they have changed their expectations, and they are beginning to adapt their corporate strategies to these new expectations. And part of that means that they are actually acting now on what we can see as a firm trend now, that supply chains are becoming increasingly siloed. And I think that comes at a cost not just to China, but to the world, that you no longer have this seamless transfer of talent, of capital, and technology.
You wrote in the report, another year of mixed messages from the Chinese government. It appeared no closer to getting an answer. What are you seeking from them? Mixed messages, how?
I think one of the biggest concerns we have had in the business community is that there seems to be this inherent contradiction between the security agenda and the economic development agenda. And what we actually saw coming out of the third plenum was that, there's no resolution. Actually, it was stated quite explicitly that they expect that there continue to be sort of a tension or a balance to be found between security and economic development. And for us, of course, what we're looking for is a clean line of sight. And it did not appear to us that we'll get a clear line of sight when it comes to sort of where exactly they put the divisions between security and economic development. That's a bit of a concern to us. And that's where we hope that, or encourage the government to be transparent with us and let us know what is coming down the road.
Which side of the fence do most of the members who are in the automobile industry, where do they line up with this potential vote coming in a couple of days, if it's not delayed, on the tariffs? There's negotiations going on, but Spain and Germany perhaps dissenting a bit. Obviously, European automakers have been here in Shanghai for a long time. Volkswagen, SAIC, they used to be the biggest foreign automaker here. Now they're struggling. I think their revenue is about half what it was in 2015. Plants are potentially closing. So how closely are you watching that potential vote, and what's the impact going to be?
We are, of course, watching it fairly closely. I mean, one thing that is concerning to us, that is that Europe does not seem to be very disciplined in terms of keeping these discussions within Europe. It seems like a lot of these discussions are being taken in public, and we don't think that that adds much value, and certainly it does not strengthen Europe's position. But I think there are questions to be asked. European companies and also European automotive have always asked themselves when they're in China, what's in it for China? And I think maybe Chinese automotive should begin to ask themselves what's in it for Europe. And I think that if you're going to find a solution, that is, there needs to be a clearer value proposition for Chinese automotive in Europe if you're going to resolve some of these issues.
Are you getting any clear signals, too, on what has been now an ongoing crackdown on investment banking in the financial sector? We're sitting here right in the heart of China's financial center, but yet there seems to be a Beijing crackdown on investment banking, job cuts, as well as remuneration cuts, and there's a demoralizing sentiment, I think, among investment bankers, and that obviously is going to impact European banks who are trying to attract talent. What's the key takeaway there?
I think, first of all, the market for European financial institutions in China has been declining. We have seen that market shares have actually been declining. But again, it goes back to what we think in the past were one of the biggest selling points of China. That was the predictability of the market here. And we're beginning to see some things happening on an ad hoc basis that are creating a little bit of anxiety and nervousness. Because again, what we want is predictability, a clear line of sight. And our encouragement to the government is give us this sort of firm framework that we can navigate within, and you will see, we still have significant faith in the long-term potential of the Chinese market, but please work with us so that we feel comfortable also about continuing working and investing here.
Jens, next conversation we have, we're out of time now, but we're going to talk about shipping because that's your industry. And you believe in the strength in exports going forward as one of the few remaining main pillars of the Chinese economy growth story. Jens Eskelund, thanks so much for your time and coming into our offices here in Lujiazui, Shanghai. Okay, guys, back to you.
Thanks, Steve. That was Steve Engel there, our Chief North Asia correspondent, with the president of the European Union Chamber of Commerce in China. And just as we were in that interview, we actually just had the strongest yuan fix of the year coming through. We saw it coming in at 7.0531, so pretty much in line with the estimate there. We do actually see strengthening off the back of that, really coming across the course what we had last week as well, because that Fed rate cut sent the yuan rallying toward a key level. More ahead. This is Bloomberg.
Yep, you just saw that breaking news just coming through here from the PBOC. So cutting that 14-day reverse repo rate to 1.85%. So it's a 10 basis point cut there. This is, of course, just a day after that jumbo size, or 2 days after that jumbo size hike from the Fed as well. Does this open the door for the PBOC for more easing is still the big question we're asking here today. We're seeing some signs of it here today as well. And as we mentioned about that fix, it was, of course, that cut, I should say, what we saw with that PBOC fix was still stronger than the spot levels as well. So it looks like they're still trying to restrain this yuan strength in some ways here and maybe try to avoid that 7 handle for dollar China as well. You're watching the China Show. The Open is next. This is Bloomberg. You're watching the China Show. Happy Monday. We're counting down to open of markets. And of course, we're coming off on a pretty good week when it comes to Chinese equities. Some signs of maybe mojo coming back to Hong Kong in some ways as well. Looks like we're hitting a little bit of a break here this morning here when it comes to the pre-market in Hang Seng. But keep in mind, we just talked about the PBOC cutting that 14-day reverse repo. So maybe more signs of some easing coming through here, too.
Yeah, coming off the back of the strongest dollar yuan fixing we've seen as well for the course of 2024. So lots of things that are moving so far in the early parts of trade. And that story of, a better week last week for Chinese equities. Will that extend as we head into another session here against the backdrop of what has been some weaker data in terms of budget spending, also the youth unemployment rate? But this is start to play here for equities on the mainland, and you're seeing the CSI 300 coming online fairly flat this morning. As we mentioned, over the weekend, we did have budget spending that slide deepening, so really quite a worrying sign for the economy. The youth jobless rate as well rising to this year's high. Some of the economic woes, of course, are largely priced into Chinese equities. It's more of a question, perhaps, of how much lower can we go from here. Muay Thai, also a name that we're watching here. You're seeing that one rising around 0.6%. We had the company announcing its first ever share buyback. It's going to be in the range of up to 6 billion yuan over a 12-month period. Citi, for instance, saying that this is the first one we've seen ever. It's a positive surprise. It could actually help to attract some longer-term investors. So one of the names they're watching in the session today. Let's change on, take a look at Hong Kong, how it's faring today. If it's looking a little bit better, you're seeing here some names in the green, for instance, Tencent, Alibaba, just some slim gains there so far. Really that bullish momentum we had from the Fed's rate cut, perhaps that could extend a little longer here. You had equity traders, you're seeing more open interest climbing in Hong Kong futures. Perhaps we've got longer to run in this rally, of course, quite a low base. Some of the names we're watching in particular, there's Midea, the white goods or consumer electronics maker that just listed just a few sessions ago, really climbing once again here today. We are actually seeing Citi, again, initiating coverage on 8 shares with a buy rating. They've lifted their price target for the A shares as well, looking at improving earnings visibility due to China's trade-in policy implementation. So another name we're watching here, Chinese car stocks or software car stocks as well to note, because we've got sources telling us that the Biden administration could be preparing to ban Chinese car software. Could be coming as soon as Monday, that policy. The pending restrictions that we're hearing about, they do come following an investigation of cybersecurity risks from Chinese vehicle software that was launched in March of this year. So you are seeing these just largely in the red so far. And property names to watch as well, given we had that scoop from Bloomberg on Friday looking at removing major home buying curbs. Again, another push to try and stimulate demand. We're seeing property stocks mostly, or all of them really, in the red so far, but the loosening, maybe something that's helpful. Is it going to really be meaningful? And so far we're hearing from economists saying perhaps not. Yvonne?
Yeah, perhaps not enough right now. Let's bring Ken Wong. He's enough. Asian equity portfolios. He's enough. Asian equity portfolio specialist at Eastspring Investments. I bet you get that a lot now, Ken.
Yeah.
Tell us a bit more. I mean, there's a bit of a melt-up in Asian equities now that we've seen this jumbo-sized cut from the Fed. Can we see more of this catch-up?
We can, and obviously I think it's going to be very important to see where the Asian currencies, head over the next few weeks. It's going to be very important. The fact is that the Fed has reduced interest rates by 50 basis points. I think, now the next step is, where is the dollar going to go? Will the dollar continue to weaken further? If we see further appreciation of multiple Asian currencies, that should help quite a bit, because we've seen, over the past few decades, is that actually with a stronger Asian currency, we then tend to see a lot more capital inflows coming back into this part of the world, which then leads to better gains for the capital markets.
How are you interpreting this Fed cut then? Was it just a sign of we want to avoid being behind the curve, or a start of something more aggressive and preemptive?
Yeah, I think this is, sort of up in the air at the moment, right? Because if you look at consensus and you look at sort of where the Fed fund futures were prior, it was between 25 and 50 basis points. So you had two camps where some were wanting to be just, slowly at a time. But then, there were some who said that things need to be done more aggressively. Yeah. So I think right now having that 50 basis points is a step in the right direction. I think it's also going to be important to see kind of over the next couple months to see specifically for the economic figures in the U.S. where things end up. And I think that's going to be very important to see by the end of this year, where markets will potentially head.
The dollar direction, though, is there anything that gets in the way of that depreciation, do you think? And what's the impact then?
Yeah, I mean, obviously, if let's say you have a strengthening of the U.S. economy for some reason, not likely, but the fact is that let's say if you get a bit of a reversal, or if inflation does, gradually come back, or if there's actually some weakening of overall economic figures here in Asia, that could derail potentially some of the recent gains that we've seen within the Asian currencies. But we don't think that's a likely scenario, but those are things that we do have to be mindful of, because ultimately, while things are gradually moving in the right directions, if you look at overall earnings growth, it's actually fairly solid. Yeah. If you look at places like South Korea, Taiwan, earnings growth are very well because of tech. But, with those two countries aside, when you're still looking at places like India, you're still seeing earnings growing roughly between 15 to 16% this year and roughly about, 14 to 15% next year as well. So you still do have fairly strong pockets of strong earnings growth, coupled with the fact that economic growth is still fairly robust in this part of the world. That's why we don't see that as a likely scenario.
You're still talking about the winners, it seems, Ken. What about the laggers? Everyone's talking about Southeast Asia, even China, on the prospect of more stimulus that could come on the way. Is there a sign that maybe we could see a major breakout in Chinese stocks, for example, now?
Yeah, I think that's the million-dollar question, right? Everybody's really waiting for that to happen. And obviously having a bit more policy support definitely does help. But the fact is that overall consumer sentiment still remains fairly weak, right? We need to see further stronger economic readings. Now, Q3 is almost over, right? So we know for a fact that looking at the initial readings for a lot of the economic indicators that we're seeing, Q3 is probably not going to be that well. Q4 is, I think our eyes are on Q4 to see whether or not we can remotely get close to that 5% GDP target, potentially that, a lot of people had set forth in the beginning of the year. We're probably in that 4.8, sort of in that 4% level for this year. But overall, having stronger consumer sentiment is going to be important. Yeah. And now reducing, sort of monetary policies or, inflecting more monetary policies could help. But ultimately, getting the consumer to spend and building up that confidence is going to be key in China.
What's going to be sort of the moment where you actually feel like you've got enough clarity to want to invest in Chinese equities? Because the government has made it pretty clear that they'd almost rather sacrifice that 5% growth target if it means that they don't have to deploy a sort of big bang stimulus. What's going to make you actually really confident enough?
Domestic investors coming back. I mean, the fact is that you have such a large deposit base in China. It's not the fact that they're running out of money or the consumers cannot invest. That's not the case at all. It's just everyone's waiting for the right time to invest. So if we start to see more of that domestic fund flows coming back into the markets, similar to what we've seen in India over the past couple of years, right? You have a strong domestic investor base that will continue to invest in the markets. Then you're going to start to see foreign investors come back into the market as well because of such a large support.
You mentioned about the flows to India. Domestic it was always there.
Yep.
Foreign investors are coming back since the election in some ways.
Yep.
But the valuations, I mean, you take a look, I think it's 2 times emerging markets. Multiples of the Nifty are like 21 times. It's the most expensive in history.
Yep.
How do you justify those valuations now?
It's hard, right? From a foreign investor's perspective, it is hard. But from a domestic investor's perspective, they're trying to put their money to work. And you look at examples. I'll give you a really good illustration. 20 years ago, look at China. Look at Shanghai Composites, right? Back then, when domestic investors were heavily invested in the markets, they were trading at 30, 40 times earnings, right? Now, India is not there yet, but again, relative to its own history, relative to EM markets, like you said, it is expensive. But ultimately, I think it's going to be important to see as well as how quickly can earnings continue to grow. Because right now, a lot of investors are continuing on the hopes that earnings can actually surprise on the upside. Yeah. And if that does happen, there's absolutely no reason why, they can stay at elevated valuation levels for some time, actually.
It's not just India, of course, it's looking pretty expensive. There's other markets in Asia that are as well trading at multi-year highs or around those points. Are there any sort of particular themes or strategies that you want to follow to try and get good value as well? I mean, some people have been talking about this could be the time that value starts to outperform, for instance.
I mean, again, that's a very tough sort of question because in each market it is a little bit different. But, in particular, we feel that, maybe some of the value signals in certain markets might be, gradually weakening a bit, especially we start to actually see people chasing again, especially with more foreign fund inflows. Once you get to actually get a bit more of the capital inflows, that's normally when you start to see some of the growth stocks and people chasing for growth. And we see that as a great opportunity for some of the Asian countries to actually, be in that opportunity and be in that bucket set. Obviously, we've seen Taiwan doing very well this year, best performing market, obviously with the growth stocks that's happening there with the whole AI trade. But ultimately, if everyone is focusing on, hey, where is the next opportunity, right? And I think the key aspect is right now is, do you continue to stay invested in places like Taiwan as well as India? Or potentially, do you start to take a bit of profit from these two markets because they've done so well in the past couple of years? And do you reallocate that maybe potentially in some of the other markets? For instance, even within China, maybe the focus is maybe a bit less on the value stocks because the value stocks and that chase for yield has been going on now for the past 18, 24 months. Maybe if you look at chasing for earnings in areas like consumer discretionaries, in areas like communication services, and some of the tech areas, that might be where the opportunity could be.
All right, Ken, great insights. That's Ken Wong, the Asian equity portfolio specialist at Eastspring Investments. And coming up, we're going to be hearing from the Rio Tinto chairman at the business summit in Shanghai, where Steve Ingles is on the ground discussing the looming supply gap for key energy transition metals. We'll have our conversation with Dominic Barton ahead. This is Bloomberg. Welcome back to the China Show. Well, Rio Tinto chairman Dominic Barton says the world needs more mines to offset a coming supply shortfall across commodities, including copper. He says mergers and acquisitions are not enough to plug the gap.
Well, Barton spoke exclusively with our chief North Asia correspondent, Stephen Ingles, at the IBLAC meetings in Shanghai, where they began by talking about the current difficult state of the Chinese economy.
It's tough. I mean, I think looking under underlying consumer demand, that's not as strong as it has been. But that said, I think there's still fundamentals that are there in terms of core investments that need to be done. This energy transition that we're in the middle of, the urbanization that's going on, the innovation that's happening on so many different dimensions. So I'm what I'd call a frightened optimist.
What kind of stimulus would you like to see in the last few months of the year to kind of put a floor on the property sentiment that could then, of course, lead to steel demand, iron ore? There's a lot of surplus in the iron ore.
So you're talking about China
right
now?
China, yeah.
I think with China, fundamentally there's a property restructuring that's going on. It's been going on for a while, and it'll probably be going on for a little while longer. I don't think this is really about iron ore or anything like that. It's about a shift in the economy. The key thing is unlocking the consumer. Right. And the challenge with that is you've got, with property prices going down and people having a lot of their wealth in property, they feel less wealthy, and we're seeing the effect of that. I think the property restructuring probably has to continue. I don't think that can change. There's a process they're going through. I think the issue is how do we give people, the consumer, the confidence about where things are moving. Obviously, stimulus programs and so forth are music to people's ears, but I think what we have to understand is there's a deeper restructuring for growth that's going on. It's tough right now, but I'm actually more longer-term optimistic. Again, when you look at the investment that's going into the greening of this economy, it's massive, and it takes steel to be able to build wind turbines and grids and so forth, aluminum, copper. From our point of view, that's going to be the urbanization is at 65%. That's where the U.S. was in the late 50s, early 60s. You've got this consumer side that needs to be unlocked. That's the conundrum. But I'm not worried about this the economy, particularly in the medium term.
Where would that lead then to your assessment of possible inorganic growth and your capital allocation going forward, given the situation here in China? And which areas would you like to see inorganic growth? Because you've been relying mostly on greenfield projects and
organic's going to remain fundamentally important. We've got this massive supply-demand gap. You're not going to inorganic your way to solving that. We're going to need to discover, mine, and process more copper in the next 30 years than we have.
Simandou, you have Oyu Tolgoi.
Yeah.
Not online fully.
Yeah, but I'm saying the world needs to do it. What I'm saying is going out there. Of course, we're going to be thoughtful in looking at where there are opportunities, but I'm saying as an industry, we're not going to inorganic our way out of the challenge because of this massive supply-demand gap. It's huge, and it's in at least 5 different commodity areas, and so that's going to need more mining. We're going to need to develop more projects, so we're just not going to be able to get it done. So, of course, we're always going to be open and interested in seeing what opportunities are there, but the fact of the matter is we need to build more to be able to meet this gap that just continues to grow.
How about in the lithium space? My understanding from those who I've talked to saying there needs to be consolidation. How much consolidation and how much of a player would you be?
I don't want to get into any specifics of it, but what I would just say is I think that there, to be able to, on the just EVs and the shift to EVs, which I, by the way, don't think is going to be about policy. They're actually proving to be fantastic cars.
So regardless of the tariff regimes that are being put in place, these are going to go someplace?
I think they're going to go. There's going to be the consumer demand for them. I mean, look at this Xiaomi SU7. You see its performance versus the Porsche Taycan. These are phenomenal cars. People are going to want to buy them. You need batteries, so you need battery materials to be able to do that. So I feel very optimistic about the growth there, and I think the challenge is it's taking a long time to be able to get permitting, to be able to build these projects. And
well, you mentioned copper, and you're having some regulatory issues in Arizona as well. Does a dare I say, a Trump administration help that? It would be a different administration, different approach?
I don't know. I mean, our view is that, we have to make sure that we're working with the First Nations that are on that property. We have a number of them that are very positive about it.
The
but
indigenous people.
Indigenous, we have to do that. But the fact that that could represent 25% of U.S. copper demand, that we could supply that's there, but we have to go through the process for it. And I think, already during the Obama period, there was a support for it, and I think the issue is we just have to follow the due process and work it through that way. As long and painful as that may be, that's what we have to do to do it properly.
You wear many hats. Obviously, chairman of Rio Tinto. You're also chairman of Leapfrog Investments, investing in, I guess, the global south and other areas. But you're also the former Canadian ambassador to China. I want to get your assessment of what's going to be the dampening effect to this bifurcation that we are seeing. Increased trade wars, global trade, geopolitics has really split the world, and nations and blocs are being forced to choose sides. What's that do to inflation? What's that do to global growth and global trade?
Yeah, I'm worried about fragmentation. As you said, I don't think we can have decoupling, because I think the impact on inflation and on the consumer is just untenable. But that's the kind of the direction, right? This fragmentation, and it has a cost. And so I do worry about that. I mean, we need resilience. We all learned we needed supply chain resilience from COVID. But this notion of fundamentally breaking down supply chains, we just have to recognize there's big costs to that. And the cost will be borne by the consumer.
That was the Rio Tinto chairman, Dominic Barton, speaking exclusively with our chief North Asia correspondent, Stephen Ingles, in Shanghai. Now to some of the other corporate stories that we're following this morning. And we've been told that Citigroup's China expansion plan has hit a roadblock with US regulators. The bank is facing delays in setting up a standalone securities firm since it's yet to receive a clearance letter from the Fed. That's required by Chinese authorities. Sources also say Citi has been instructed to resolve its data management problems at home after being hit with a $136 million fine in July. Morgan Stanley is reportedly facing a regulatory review of a sell order for SK Hynix shares placed before it published a downgrade report. Yonhap says Korea's financial supervisory service is planning to look for any unfair acts related to SK Hynix trading. Shares of the chipmaker tumbled more than 11% last Thursday after Morgan Stanley slashed its price target and cut its rating. Bloomberg has learned that Apollo Global Management has offered to make a multi-billion-dollar investment in Intel. Sources say the alternative asset manager has indicated it's willing to make an equity-like investment of as much as $5 billion in the chipmaker. We're told nothing has been finalised and the size of the potential investment could change. That development comes with California-based Qualcomm said to be floating a friendly takeover of Intel in what could be one of the biggest ever M&A deals. Sources say Qualcomm's been speaking with US regulators and believes an all-American combination could allay any antitrust concerns. We're told Qualcomm also hasn't ruled out buying or selling parts of Intel in a combination. We'll have more ahead. This is Bloomberg.
All right, checking markets here right now in terms of one of the biggest movers that we're seeing across MSCI China, and it seems like this offshore market continues to see some decent gains here when it comes to some of the big sort of large caps like Xiaomi is up some 3%. Alibaba is also up by close to 1% here this morning. Wuxi AppTec also gaining some 6%. So it certainly seems like Hong Kong is getting a little bit more mojo after that Fed cut and maybe being one of the key beneficiaries of that 50 basis point reduction from the Fed, given the fact that we saw HSBC and some of their peers actually cut their lending rates for the first time in a few years as well. So it seems like that is certainly going to help with things like household mortgages, for example. The property sector could finally get some relief. You take a look at how the stock technical chart is interesting, right? Where we basically are starting to see in some of these ETFs and the flows that were coming into there, that there is some sort of triangular breakout pattern that is breaking out. And this is the iShares MSCI Hong Kong ETF, which is rising rising above that resistance level here right now. So technicals are suggesting maybe we could see some sort of breakout. We'll see if that continues on. But yes, we are seeing about 0.4%. So extending that rally now in Hong Kong as well as in the onshore markets here today. You take a look at how the benchmarks are doing. So CSI 300, we're seeing gains about 0.5%. So yes, we did get that 14-day reverse repo cut, which was a bit of a surprise from the market in some ways. But, you know, the analysts that we've been talking to so far are saying, look, it looks like this is just a catch-up to the cut for the 7-day just a few weeks ago. It might not change markets too much, but it certainly is helping sentiment just a little bit, Bill.
Yeah, actually, we've got, when you take a look at trading volumes, we're above the 20-day moving average and pretty significantly in Hong Kong as well, just something to note. But taking a look, broader markets today, and China is really, of course, leading the direction for sentiment, given we've got Japan that's closed for a public holiday. We are seeing equities just looking slightly mixed. You've got Australia, New Zealand under pressure here. Most others in the green, though. Commodities, though, you are seeing a contraction, a pullback in the likes of aluminium and steel in Shanghai, down 2.5%.
Welcome back to the China Show. Here's a look at the Asia side just a half hour into the session. Looks like the good vibes continue here. We are seeing elevated volumes coming through when it comes to Hong Kong stocks. If you take like 8 shares as well, we've basically been gaining for 7 straight sessions now. So certainly you're starting to see a bit more momentum come through here, whether it's the policy signals that we've been seeing, that 14-day reverse repo cut, which came as a bit of a surprise this morning from a lot of traders as well, did help at least stoke some optimism here today, Bill.
Yeah, and of course, it's really that reaction we're continuing to see to the Fed rate cut coming through, particularly for Hong Kong. You're seeing open interest in futures that's rising as well, so it tells us perhaps there could be more in this rally to run. But let's also take a look at what's happening with the Chinese yuan this morning, because we actually have seen it under pressure against the greenback so far. We had that stronger yuan fixing coming through, and then, as you said, we had the PBOC cutting the short-term interbank lending rate as well, the 14-day reverse repo to 1.85% from 1.95%. Yes, it could be perhaps that story of looking to sort of blunt some of the yuan gains. It seems like the PBOC maybe doesn't want the yuan reaching that 7 line too quickly, even though broadly some of these dynamics are very much out of control of the PBOC, given it could be that dollar story as well.
Yeah, and I think Stanchart was the one that said, look, you know, it's unlikely that CNH is going to outperform Asia or G10 FX, right? Given that, you know, it seems like we've seen the Fed really open the window and kick the door open for many of these central banks in developed markets to cut rates. SMB, Sweden are all meeting here this week as well. We have an RBA decision. They might sit tight, so that might add a bit to the Aussie dollar, but limited downside, they say, to dollar China from these current levels. You take a look at how CGBs are doing, and it looks like this rally continues, right? I think we've been basically seeing CGB yields lower 9 out of the last 10 sessions as well. So that cut obviously did add to that sort of rally there. We're at 202 levels for your Chinese 10-year yield. And the rest of Asia, well, with Japan shut, still looks okay and decently well.
Yeah, we're seeing looking fairly flat right now, but trading volumes are elevated for a lot of different benchmarks, and you are seeing those more tech-heavy index rising as well. The Taiwan benchmark, the Kospi as well. Singapore, we've continued to track at around multi-year highs. The Japanese yen, a little weaker here again against the dollar so far. Commodities, a bit under pressure, especially when you look at the iron ore contracts in particular. That could perhaps be a story of concerns around the health of China's economy. We still had that slowdown in budget spending. We still had that youth unemployment rate climbing. But we do still see Chinese stocks enjoying a pretty positive mood.
I mean, it seems like this Fed pivot overshadows some of those at least the macro concerns for now. And that really kind of bodes well for the rest of Asia as well. U.S. futures are still punching higher here this morning. Waller, I think what we heard from Governor Waller as well, talking about, you know, he's still open to a 50 basis point cut if the labor market weakens furthermore from here. That certainly did lift in some ways risk assets overall. For more, let's bring in Mark Cranfield, MLI strategist. Mark, it seems like Asia's in a bit of a Goldilocks scenario here right now. How long can these stocks and currencies really embrace this rate cutting cycle from the Fed?
Quite a while, most likely. It's a global scenario. What the Fed have done is really to lift all boats, basically. You had the US economy was expanding reasonably well, and then you throw a 50 basis point rate cut on top of that, then obviously the mood is going to be pretty good. It's a question now of people rotating into the things that have been lagging behind probably. And for Asia, that's a really good thing, because you're going to get probably a double whammy here, where Asian currencies and Asian stocks both start to feed into each other and both do well. So that could run probably right into the US presidential elections, really. So the momentum here is going to be pretty good. People looking for the markets that have been a little bit behind, particularly as money will probably come out of the United States now. People will think that even though the Fed is starting to lower interest rates, they'll probably see better opportunities in valuation terms in other parts of the world. Asia will probably stand out, especially with the currencies having been relative laggards compared to some of the other parts of the world. And then when you look at what China did this morning with the repo cut, although it was probably affected by the holidays, they're going to have this 5-day holiday for National Day, they probably brought forward something they were planning to do anyway. But the surprise element of that is also positive as well. So that will help Chinese and probably Hong Kong equities run pretty nicely into the National Day holidays that begin next week. So all in all, you're getting everything falling into place where people can feel good about risk assets. Now it's just a question of trying to find the ones that have the best catch-up play.
Mark, where does the Japanese yen sit in all of this? Because against that backdrop of the Fed, you also had the BOJ meeting on Friday, in a way to sort of sending that messaging that even if there were some, including our Bloomberg Economics team, that thought a hike could be possible as soon as October, it's been very much pushed out into next year.
Yeah, I mean, that's, again, that will, to an extent, that will help Japanese equities when they come back from their holiday tomorrow. They will probably see that as a green light to continue going, because what will most likely happen now is that the yen will probably fall into a trading range. So dollar yen itself may well drift between 140 and 150, which will be a net positive for Japanese equities. The yen will probably lag behind some of the moves in other major currencies, similar to what the Chinese currency most likely is also going to lag behind where the Korean won goes, where the euro goes, where some of its competitors will fall. So from a Japanese investor point of view, you're probably going to favor equities over bonds for now, as the yen becomes a bit of a sideshow. It had been very dominant, particularly in August and the early part of September. People were trying to reevaluate where was the fair value for the Japanese yen. In the next few weeks, it will probably not matter as much as what happens to the euro, what happens to the British pound, indeed even where the Aussie dollar goes as well. From Asia's point of view, there'll be a lot of eyes on how the Aussie dollar responds to what's happening in China. That will be a good barometer of how positive people feel about the region.
Mark, thank you. Mark Cranfield there, MLS strategist, joining us out of Singapore. Some major data points, of course, we're watching out for this week and your week ahead. So we talk about CPI numbers, that's coming through in the likes of Australia here today. The RBA decision, as well as Mark mentioned, might keep the Aussie pretty supported here throughout the week. Also, we have that MLF rate for the China 1 year. Perhaps this 14-day reverse repo cut may not be more important than what could happen with MLF rates this week as well. The big one is going to be the U.S. August price PCE, the Fed's preferred gauge for inflation, certainly if that actually justifies that 50 basis point cut that we saw last week. There's also a ton of Fed speak. I think there's about a dozen of them that will be speaking this week as well. And to wrap up the week, we got CPI numbers out of Tokyo, also industrial profits out of China as well, Bill.
Yeah, and the LDP election, one to note in Japan as well. But more on elections, of course, ahead, because we've also been tracking what's happening in Sri Lanka. And we saw a leftist candidate winning that tightly contested vote after the country's first ever runoff of the weekend. We'll get an update from Colombo just ahead. This is Bloomberg.
Well, Sri Lankans have elected a leftist political outsider as president, rebuking elites who bankrupted the nation and imposed stringent austerity measures backed by the IMF. For more, let's bring in our senior reporter, Dan Stumpf. He's joining us out of Colombo this morning. And Dan, just tell us more about this new president.
Yeah, hi, good morning. So he's very much a political outsider here in Sri Lanka. This election is the closest really the closest election in recent history. It's the first ever runoff election, a very closely contested race between three major candidates. One thing that makes this candidate, Dissanayake, stand out is he's from outside of the sort of the political mainstream in Sri Lanka. He's not a member of one of sort of Sri Lanka's well-connected political families that has ruled this country on and off over the years. And he's come in with a very clear, direct promise to sort of help ordinary people who have been hurt by the crisis that has hit this nation so hard over the years, and still being felt 2 years after what was really a historic debt default that this country went through.
Yeah, does that debt sort of restructuring, is it put in doubt now given Disanayake's election?
Well, to an extent, it is. I mean, he came through this campaign with a promise to sort of reopen the IMF process that was agreed to a year ago by the outgoing administration. Now, that process came with it a $3 billion bailout, and as well as some significant restructuring requirements, as IMF bailouts always do. So some of those requirements that were pushed through by the outgoing administration included things like higher taxes, sale of state assets, removal of some subsidies, just to meet some benchmarks to raise revenue and reduce the deficit here in Sri Lanka. So these have been unpopular measures that have been really felt by ordinary people over the last 2 years, and is a major reason why you saw this political upset and why voters ousted the last administration. So a lot of the specifics of what he wants to do to restructure this deal still aren't clear, and that will hopefully become more clear in the weeks and months ahead. He said he doesn't want to throw out the IMF deal altogether, but you may see a process where some renegotiation of some provisions comes in, and some efforts are made to sort of alleviate some of these measures that were taken that were really felt by ordinary people here in Sri Lanka.
And it seems that, I mean, this is a nation that heavily relies on Chinese funding as well, especially when it comes to ports in Sri Lanka. Dan, I'm just wondering, what are the consequences of this election on those relationships with China and India, too?
Well, it's true. I mean, Sri Lanka does sit in a very sort of strategic location, right sort of at the south of India. India, of course, has very close relations with Sri Lanka and is also a major investor in the country. Sri Lanka is the biggest foreign creditor. China is the biggest foreign creditor in Sri Lanka. And this has led to some real push and pull. As we all know, India and China are strategic rivals. India is quite close to the U.S. on this issue. Dissanayake has said that he wants to more closely scrutinize foreign deals, foreign investment that has come in. A lot of the foreign debt coming in from China has taken the blame for the debt crisis that this country went through in recent years. So, I think we can probably expect more scrutiny of some of these foreign deals, more scrutiny of some of this foreign debt. But at the same time, Sri Lanka does need foreign investment. I mean, this is a country that imports everything, essentially. This is a country that is really reliant on foreign investors to build things, as you said, like ports, highways, infrastructure. Everywhere you look, you really see a lot of foreign investment that's behind a lot of the construction here these days. So, it will be an issue that does take center stage, though, in the next weeks and months to come.
And of course, just tracking more of that FDI that we're seeing from China in particular, because this chart really puts it in perspective here, looking at total Chinese investments in ports. Beijing, of course, is investing not just in Sri Lanka, around the Asian region, far beyond that. Actually, Tanzania tops the list here, Australia, Guinea, and then Sri Lanka in fourth place here, $3.9 billion invested so far. Hambantota, of course, that's probably the best known port example. It's been sort of criticised by many for being a debt trap. trap. Others would disagree, but certainly Chinese investments in Sri Lanka, not just that focus on ports, because you take a look at this map here and we can see investments in infrastructure, transport, even cultural as well, taking a look at some of the value of those. So the larger circles representing north of $1 billion, medium around $500 million, and the smaller ones $0.25 billion. But certainly these are projects that were committed to be delivered between 2000 and 2021. This is taking a look at data from a data research lab at the College of William and Mary in Virginia, Yvonne.
Yeah, and China's foreign infrastructure investments have raised concerns over security risks in the Asia-Pacific and beyond. For more, let's bring in Mohit Iftikhar, lecturer in comparative public administration at Lingnan University in Hong Kong. Mohit, it's great to have you. First and foremost, maybe we could take a step back and talk a little bit more about what really led to this sort of rise of China's dominance in these ports.
Good morning. Thank you for having me. So we have to look at the background. Initially, the port investments in Sri Lanka, Hambantota, they were not a part of the Belt and Road. If you look really on ground, this investment translated back in 2006 and 2007. And initially, this port investment was pitched to, I believe, other regional and outside powers, India and the U.S., but at that time, nobody was willing to invest in Sri Lanka. It was largely because of the ethnic conflict that was happening since 1983 to 2009. So Sri Lanka was a really bad place, and the government and their public spending on infrastructure was less than 6.5%. So at that point of time, it made perfect sense for China to come in. So per se, this investment was prior to the Belt and Road. Yeah.
What led, though, China to invest in it? Because there were a number of feasibility studies looking at Hambantota in particular that said this was not a good project to proceed with, especially at that sort of scale. So why do you think China then agreed to pass over the funds when the likes of India, for instance, were not willing to stump up any cash?
So in places where there's high risk, such as Sri Lanka at that point of time in the mid-2000s, because of the security situation, nobody was willing to invest. And any investment that is made, there are a lot of there are a series of meetings that happened before. So it was Sri Lanka that pitched the idea. It was not China. It was Sri Lanka, and it was under the government of the former president Rajapaksa, and it was at that point of time it was his infrastructure spree because he wanted to bring in, and largely was also part of his election manifesto as well for that political survival. Yeah.
To what extent do you think these ports are becoming geopolitical assets?
So with economic objectives largely come geopolitical objectives as well, meaning you have to secure your trade networks. If you have companies there, you want to also add value to those the supply chain networks. So per se, geopolitics not necessarily means military dominance. It also means controlling essential trade lines, the critical supply of materials. So this is what it means. Not entirely per se.
Not really like building military naval bases, for example.
Exactly.
Yeah.
Even though, I mean, sort of the counter argument to that, I guess, is even if China's being driven by economics, the amount of leverage it has in Sri Lanka now means that its infrastructure assets, like that port in particular, could be used for military purposes.
So there are two things now. One is normal military diplomacy, where naval ships go to different ports, they make port calls, which is a normal part of military diplomacy. But at the same time, you have to look on ground the other Chinese investments in Sri Lanka, some of that you were discussing earlier, for instance, roads and highways. Because of Chinese investments in Sri Lanka, their road and highway networks have increased at least 60 to 70%. Same for energy sector. Also, they have that famous monumental building, the Lotus Tower. So per se, it's not military, but it can be military diplomacy, but it doesn't mean the same thing as projecting power. So it means normal visits to ports.
Some of the consequences of this dominance that we're seeing in China in some of these nations like Sri Lanka is this complaint of death traps, and that some of these ambitious projects don't quite materialize the way that they're initially proposed. You're saying those are not fair arguments. Why not?
I do, because you have to look on ground at domestic political economy of different states, because it is the domestic political economy where Chinese investments have to navigate. It's the bureaucracy, it's the political leaders. So once you sign agreements on paper, they have to navigate that complex black box. For instance, the former leader, when they signed the agreements, it was basically his cabinet members, part of his close network. But when of these investments started to translate, there was a lot of intervention in bureaucracy. Take this Hambantota port. It's in the home constituency of Rajapakas. So it makes that sense that we also have to explore that domestic political economy, the bureaucracy, how it functions. So we cannot entirely put the blame on China over here.
What do you think, though, it happens now? Because, we've got a new government in place. They're looking to scrutinise all of these investments from China, other places as well. But what do you think the outlook is now then?
So I think for the incumbent president-elect, he has to navigate a lot of domestic political and economic realities. One is, of course, the IMF. And in terms of IMF, this is the first time you have a leader, as your former colleague, as your colleague Dan mentioned, that has not happened before. So Sri Lanka started to liberalize back in the late 1970s, and now he has negotiated the IMF as well in terms of state organizations. But there's a lot of speculation. So one argument that I'm also looking at is how would Sri Lanka respond to the BRICS as well? So minus the speculation, so there should be some type of a balance. But it's too early to say what would be his foreign policy response.
What's going to be the response from the U.S., even Southeast Asia, even allies like Japan? I mean, do they have the political will to be sort of these alternative funding options as a counterweight to China?
That's a good question. So back in 2013, when the Belt and Road initially came in, I guess for the U.S. and allies and institutions such as the World Bank, Asian Development Bank, there was a sense of realization that there's a major infrastructure gap in Asia. I think it is 1.7 trillion at that point of time annually. So how do we accommodate that? So Belt and Road made perfect sense, and it was also part of the failure on these agencies that they cannot provide. And in many ways, the Belt and Road does not compete, instead complement these international donors. Yeah.
All right, that was Mohid there. Mohid Iftikhar, lecturer in comparative public administration at Lingnan University in Hong Kong. And we're going to have more in Sri Lanka ahead. We're actually going to be hearing a little later from the head of the Colombo Stock Exchange, that's Dilshan Wirasakara. An exclusive conversation coming up at 11:40 a.m. if you're watching from Hong Kong. We'll have more ahead on the China Show. This is Bloomberg. Welcome back to the China Show. Here are some of the stories that we're tracking this morning, and at least one person was killed and several others are missing after torrential rains caused flooding in parts of northern Japan. The country's weather agency says Saturday's rainfall reached the highest daily tally for the area since the agency began recording data. The region is still recovering from a deadly earthquake that struck at the start of this year. Latest polls suggest Japan's former Environment Minister Shinjiro Kozumori is the top choice among lawmakers in the ruling party's leadership race. Surveys by the Sankei and Mainichi newspapers published over the weekend gave Kozumi the most votes among the 9 contenders to lead the Liberal Democratic Party. If elected on Friday, the 43-year-old would become Japan's youngest prime minister. Democratic presidential nominee Kamala Harris is leading Republican Donald Trump in 2 national polls of registered voters released on Sunday. However, the CBS Ipsos survey has all 7 key swing states as toss-ups, with Harris leading a slight edge in all but 2. The NBC poll found 48% of registered voters see Harris in a positive light, compared with just 32% before she entered the race in July.
All right, take a look at market checks here right now. Movers, in particular, Sino Ocean. This is a property developer in China. Seeing some slight gains here. We pare back a little bit to initial sort of spike there on news that it will take a parallel debt restructuring processes. So this is what we're hearing according to that Hong Kong Stock Exchange filing that came out over the weekend. Take a look at how liquor stocks are doing, really reacting to what we saw with Kweichow Moutai planning to buy back 3 billion to 6 billion yuan of shares. This is the first ever repurchase plan from the company as well. So a positive surprise according to the likes of Citi. Take a look at Moutai. Stocks are up 1% here. Wuyangye also up by about 2.5% here this morning. And yeah, as Citi mentioned here, this is the second corporate action to raise cash returned to shareholders in the past 2 months as well, after they did raise that dividend payout for the 2024 to 2026 years as well. So restoring, hopefully, confidence in investors in the long-term growth outlook there. Cutting more ahead. This is Bloomberg.
Welcome back. We're an hour into the cash session, in Shanghai and Shenzhen. We're seeing the CSI 300 just continuing that advance that really started in the middle part of last week here. But generally, it seems like traders are getting more optimistic on mainland, but also Hong Kong stocks in particular, following the Fed cut last week and really shrugging off perhaps some of those weaker economic spots in terms of youth unemployment, budget spending that happened at the end of last week as well. But we're also hearing from what's happening on the ground in China, because we've seen executives from some of the top multinational firms, including GM, Adidas, HSBC, Rio Tinto, gathering in Shanghai for the 36 International Business Leaders Advisory Council meetings. Our Chief North Asia correspondent, Stephen Engel, has more on what was discussed at the conference. And Steve, I mean, it's great to be able to hear from so many different executives about their views on what's happening in China's economy and how much that's impacting their bottom line for their businesses. But what was the mood at the event, and what were some of the conversations you had there?
I think the mood was pretty optimistic, but I must correct you. We have to scratch out the line of General Motors CEO. She was supposed to be here, Mary Barra. She is part of the IBLAC, the International Business Advisory Council, Business Leaders Advisory Council, that has been, meeting here in Shanghai every year, except during the pandemic. Obviously, they meet with the Shanghai mayor. They talk about opportunities of collaboration and cooperation and where they can invest. The foreigners can invest in this city. Obviously, Shanghai, which has a history of bridging East and West and being a facilitator for business. I mean, look, General Motors set up joint ventures with Shanghai Automotive, SAIC, but things are very difficult. Things are much different right now. Their revenue is down. Their profitability is down. Actually, they're losing money in China after once being the biggest foreign automaker in this market in China. Things have definitely changed because of the rise of the Chinese EVs. So they did talk behind closed doors and also in the public sessions about the areas in green tech where they can cooperate, and not as much about the struggling Chinese economy. That's something I think the Chinese leadership here and the Shanghai mayor perhaps doesn't want to talk about. It's the big elephant in the room, in the building, just out the window here across the river for that one day on Sunday. One person who wasn't afraid to talk about the slowing Chinese economy is the biggest ad man in the world. He's very well known, of course. That's Sir Martin Sorrell of S4 Capital. I talked to him there on the sidelines of IBLAC, and he says China needs stimulus now.
The three things that we see going on in China is the Chinese consumer is becoming much more value conscious. We see outbound Chinese very significant. People say that Google and Amazon and Meta don't have Chinese businesses. They do. It's called outbound Chinese. It's Xiaomi, it's all the EV manufacturers, Oppo, Vivo, it's Alibaba, Tencent, and TikTok. So outbound Chinese is huge. And then thirdly, the growth of Chinese brands. Don't underestimate this. And Chinese coming back from a US education. I saw a company called Minimax here, which is an AI company, text to video, text to voice growing. So the power of the Chinese brands. So the background is difficult, and there's deflation as well, as you hinted at. So real interest rates might be 2%, but deflation's 3%. So real interest rates are very high. What's going to happen? The pressure is building. I think the Fed taking
50 basis points,
50 basis points cut out, and perhaps going further, gives the Chinese a little bit more wiggle room. But I think the pressure is intensifying, and the thing I'm looking for is for the government to change their stance here and be a bit more expansive, because they do have wiggle room.
But they've held off from doing that. They don't want to exacerbate.
They've done a little bit. They've done a little bit. They've done it in small steps. I'm looking for a bigger step, because they do have flexibility on interest rates and lowering them, and they do have flexibility with central government budgets, not local government. So they can spend a bit more money. So that's what I'm looking for. I'm looking for a little bit of a reversal in the policy. In the absence of that, I think it continues to be quite tough.
For how long? Because Again, one of our last interviews that we did, I think it was in 2011, you said the global shift of power, influence, and money is unstoppable to places like China, to India, to emerging parts of the world. It's a long time ago. A lot has changed.
I think it's intensified that. See, I think they're really interesting. If the Americans, if Donald Trump is elected, which probably looks less than 50-50 at the minute, because it looks like Kamala Harris has made some ground in it, but maybe even with Kamala Harris, if tariffs are increased, that puts further pressure on the Chinese economy. Now, the US economy is about $28 trillion in GDP. The Chinese economy is 18, so it's 46 out of about 106 for the world. What I'm saying is the Chinese should concentrate more on the 60 trillion that's outside US and China. So global South v global North, going into Latin America, going into Africa, going into the Middle East. And the Chinese are doing quite an interesting job in Europe now on EV tariffs, for example. I mean, you've got Spain and Germany saying...
Resisting. And Hungary is opening its doors for manufacturing. Viktor Orban there.
Well, I remember the head of Chery in Europe, I think it was, but they introduced EV brands into... They've got a plant in Spain, in Barcelona. The CEO was asked, are you going to open up a plant in the UK? And he said yes.
So this is where a lot of this excess capacity, industrial capacity, can go to places like Africa and South America.
Now, the problem is these markets are much more fragmented. They're obviously smaller. But in total size, I mean, they may be more difficult to penetrate because they are more fragmented, but in total size, and given the growth that you're seeing in those markets because of the shift to the global South, I think there is some logic to it. But what I'd like to see from a Western point of view is for China to be more aggressive in terms of its stimulation, both in terms of interest rates and spending.
And as you can gather there from Martin Sorrell, obviously Shanghai has played a critical role as a manufacturing hub, a financial center of China, of course, then manufacturing all in the neighboring provinces of Zhejiang, Jiangsu, and elsewhere. That is taking a bit of a licking right now, especially on the automobile front. But as you could hear from Sir Martin Sorrell there, he believes that China's big strategy really should be, rather than trying to bang your head against a brick wall, I paraphrase, and try to sell your EVs into markets like the United States and Europe, you should sell them into the global South, into emerging economies in Africa and also Latin America and into Southeast Asia.
That was our Bloomberg Chief North Asia correspondent, Stephen Engel, there in Shanghai. And also what we heard from there was that point being made around this call for further stimulus in China as well. But what's interesting is how that call for stimulus is also just coming up against local governments whose budgets are looking a little constrained now as well, given you've got that drop-off in land sales and the effects of that property slump that continues to play out. But let's get more on that now. Bring in our economist, Eric Zhu, for us in the studio. And Eric, we've seen the effects of this slide in land sales playing out in budgets, because we've seen that spending slide just deepening in the data out on Friday.
Yeah, I think, but that's only probably part of the story, because if you even look at the general spending, it's also very slow this year compared with the progress in past years. So that's, I think, one critical constraint now is the local officials. They are not allowed to spend money, in whatever way you wish, because there's how you're going to spend the money, what projects you're going to invest in. It's now under more scrutiny from the central government. So local government will be more cautious, because you have to prove this project is worth for investing, that can generate revenue in the future. Well, it's not going to create another debt hole. So unless you can prove that, then local government would be very cautious of spending the money. So that, unless some relaxation on that front, we don't think. And another thing is, if you misspend money, or if you invest in something not really worth investment, and you will be held for accountability probably over your lifetime, right? Even after you leave the post. So local officials will still probably get punished for those misspending. So I think that's a very critical, constraints on how local governments are willing to spend money. Although the budget set in March this year, I think it's broad enough, right? It's the budget side. The side of the budget, it should be big enough enough, to spur the growth, to help the recovery. But we don't think, we think a key constraint now is the local governments are very cautious in spending those money.
That's the fiscal side and the challenges that you highlighted quite well, Eric. What about the monetary side? I mean, this cut to the 14-day reverse repo. How should we interpret this move?
The bottom line, don't get too excited over it. It's not a new stimulus, not a new cut, because you remember last time they did 14-day reverse repo was in February, before Chinese New Year. So that's quite, it's quite seasonal, because they only do that usually before the long holiday. So now we have October Golden Week. So they want to catch up the 14-day rate with the July's cut in 7-day repo. And remember, they didn't move the 7-day repo this morning, so it's not really a new cut.
We had the scoop on Friday as well, this story from Bloomberg talking about weighing removing major home buying curbs to try and stimulate demand. You've written the reaction, and it seems like from your perspective, again, it's sort of could miss the mark here a little bit.
Yeah, I would say if they did that 1 year ago, that's probably more useful, more helpful. But now it's probably too late. And given, another year passed on, and the sentiment was even weaker right now. And even, relax the curbs in those larger cities, it's not help to resolve the nationwide problem, the oversupply issue, right? And we should know that the key oversupply is not in those top cities. It's more in those lower tier cities, right? So the demand is still, I think, quite robust in those big cities, but the thing is the fundamental demand is too weak in outside those cities.
I do also want to ask sort of about some of the risks possibly of this, because it's really interesting what you've written in your research, talking about that even if you loosen these rules, it can still come at the expense of smaller cities as well, and they're the ones that actually need that level of support.
Because everybody, they hope for the big city, they want to buy a home there, right? So if you relax those every people can buy homes there, then it will just attract buyers from outside the big city. But that's crowd out those demand, which are already even weaker in those smaller cities, right?
All right, Eric, thank you. Eric Chu there from Bloomberg Economics joining us there on what's really going on. Let's talk about what one property developer, China, Aoyuan. It is surging here right now in Hong Kong. So we were actually surging as much as 148% at one point. We're now back to just 90% gains right now for Aoyuan. But really, there's news of a new strategic investor. So introducing Multi-Gold, and it will become the single largest shareholder of the Chinese property developer to replace Guo Ziwen, according to this exchange filing as well. So that certainly is sending the stock flying this morning. Belle.
Yeah, huge move there. But coming up, we're going to be hearing from JPMorgan, because they're joining us to discuss their annual India Investors Summit and the key themes that are shaping today's landscape in India and beyond. We'll have more ahead. This is Bloomberg.
Well, the annual JPMorgan India Investors Summit begins in Mumbai today, bringing together senior executives and investors to discuss the key themes shaping today's landscape in India and beyond. Our next guest is one of the featured speakers. Joining us now is Navin Wadhwani, head of India investment banking at JPMorgan. Also with us is our Bloomberg senior editor, Menika Doshi. Navin, it's great to talk to you. I mean, obviously, there's a lot going on in India, so much optimism around this bull run in equities, for example. Tell us a little bit more about the iBanking outlook right now in terms of IPOs, in terms of M&A. What's the environment like?
Okay, thank you, Yvonne. Good morning, everyone. So look, I think Indian equity capital markets are right now at all-time high, and in terms of the way the transactions and IPOs and public market transactions are happening, it's pretty interesting to see how that's shaping up. If you really see this time around, it's a bit different. You have a lot of domestic financial institutions who become bigger, broader, and deeper, are investing and contributing a lot to this whole increase in the activity that you see in the Indian IPO market. Just to put some numbers in context, this year effectively domestic financial institutions have deployed $38 billion plus of capital, and whereas foreign institutional investors at around 11 billion. So this just shows the quantum of capital that the domestic institutional investors are contributing to the market. And this is clearly on the back of a lot of SIP flow that we are seeing. It's around $2.5–3 billion of per month of SIP flows, which is fueling the market in some form and shape to kind of provide that capital. And I think there is also a bit of a structural shift in the way a common Indian is actually looking at things. In the past, they were focusing more on fixed deposits, deploying the savings in fixed deposits, but now they are actually deploying more in public markets. So that kind of adds to the mix. In addition to that, I just feel the entire India growth story, the thematics that is really playing in terms of Make in India, for India and for the world, the infra spend that is happening, the energy transition that is going on, the digital transformation that is happening clearly at the pan-India level, the way an Indian is transacting today, the access and ease to the public markets because of digital transformation, and of course the consumption-led growth story, all that is adding up to the entire activity that you're seeing in equity capital markets.
Navin, hi. Menaka here in Mumbai. Welcome. I wanted to quickly check with you on when do you see M&A activity pick up, especially in terms of big deals? Because some data indicates that in the first half this year, total M&A value did decline. It could have been because of higher interest rates, but we seem to be turning that corner now, unless you think these rich valuations will play to the downside.
Yeah, so thank you, Menka. No, absolutely right. In terms of the M&A activity, I think it can certainly do more. But just to put some numbers in context again here, if you look at the last decade from 2011 to 2020, the annual average M&A volume was around $70 billion. And if you see from 2021 to 2024 year to date, the annual average volume is around $140 billion. So it has clearly doubled. Having said that, I think M&A will benefit out of the elements that I talked about on the India thematics per se. But what is also changing this time around is that, look, there are deals happening. There is a lot of activity from the financial sponsors. Private equity investors are very actively buying and selling businesses, building businesses. And that activity, I think, will continue. We are seeing some amount of M&A activity and interest from some of the global strategics, especially in the financial services, in terms of banking, NBFC, insurance. There's a lot of discussion happening around in the boardrooms of the global companies. How do they want to play the India growth story? And some of the thematics that are kind of unfolding right now are that they want to, unlike in the past where they want to do large global transactions, large size transactions, they are playing a partnership approach. They want to be in partnership with Indian players. They want to look for JVs. They want to look at strategic minority positions. And the other thematic that is clearly playing from a global perspective is that a lot of MNCs are actually going and raising, getting the Indian subsidiaries listed, or actually trying to also see how they can use that currency to deploy that in terms of the valuations that you see in the Indian market. So I would say that M&A outlook is looking better, but given the equity capital markets are also pretty active right now, we see the table turning in this coming year in 2025.
Navin, do you see more than just Hyundai and LG looking to IPO in India? And I have to ask you this, would you know when the big Reliance IPOs are likely to come to the market, given that you worked with them at one time?
Yeah, no, so look, in terms of the MNC thematic, I have mentioned to you that there are several companies who are evaluating and actually, and in fact, in the process of executing, taking their Indian subsidiaries to public markets. As far as Reliance, I would not like to comment because it's there in the public domain enough about how they are planning their potential, public raises. So I would decline to comment on that, please. Thank you.
Navin, you did mention that you're seeing lots more partnership-style deals and fewer buyouts. This is interesting because we've just seen the Indian regulator recently propose a change in rules which allows for easier delisting and therefore paves the way for bigger buyouts. Do you think India will probably never be, at least in the near future, a big buyout market?
Look, if you are looking at from a perspective of global players wanting to come to India, I think there is a big valuation concern that a lot of the global strategics have. Though, of course, if you had to take a long-term view, a lot of this will play out really well because earnings have been, growing well. And as a result of that, it should in the long term play out well. But also India is a complex market, right? Meaning you need, it's more like a continent. So I think the global players have also recognized that having partnerships with Indian players who are becoming big, they are more institutionalized. It's a better way to play the India growth story than just come and do a large buyout and try and kind of integrate with their global businesses. So I think that is a fundamental shift that I am seeing in some of the players. Very clearly, we are seeing in some of that in the financial services where people are wanting to take strategic minority positions also with some of the Indian banks, Indian NBFCs.
Navin, that's all the time we have, but thank you so much, Navin Wadhwani, there, Head of Investment Banking India at JPMorgan, and have a great conference this week. More on this year's India Investor Summit coming up. JPMorgan's Global Head of Capital Markets, Kevin Foley, joins us the next hour to discuss India's position among Asian peers when it comes to fundraising. This is Bloomberg.
You're watching the China Show, taking a look at some of the movers as we head through the session for mainland and Hong Kong this morning. Chinese car software stocks, we're actually seeing them looking, well, these ones actually mostly to the upside here. They have been a bit mixed so far today. But what we're hearing is that the Biden administration is preparing a ban on Chinese car software. The proposed rules targeting that technology could be released as soon as Monday. And the move could include bans on the use and testing of Chinese and Russian technology as well for automated driving systems and vehicle communication systems. So these restrictions could mostly focus on software, but could include some hardware as well. Certainly, we're already seeing EVs from China in the US looking very challenged, really, given you've got high tariffs of as much as 100%. What else we're tracking is Chinese biopharma firms, because we're seeing some gains here across the board today. We do have some key absences, including WuXi Biologics, from a proposed set of amendments to the National Defense Authorization Act, or the NDAA, in the US. They did not mention the Biosecure Act, so that likelihood of passage is still high, but the exclusion is why we're seeing, of certain names, that exclusion is why we're seeing some of those gains today, Yvonne.
Yeah, and so it's pretty interesting, right? If you take a look at what we're looking at here across some of these multi stocks here as well. That buyback program certainly is one big one for Kuei Chow, and that's really leading to liquor makers to go higher up here today. We're also focusing on what really goes on. That 14-day reverse repo cut certainly was one good sign. We also have this PBOC, CSRC, and NFRA meeting tomorrow morning at 9 a.m. to watch out for as well. That certainly might be why we're seeing a bit more upbeatness here today.